So secure versus unsecured, this has been coming up as the marketplace lending industry moves into a stage of broadening and going into different asset classes. Today we have a pretty distinguished panel, and we want to go through and have a little bit of a discussion on secure versus unsecured in the different asset classes and what really offers the best risk-adjusted returns, especially in different circumstances. But to kick it off, I would like to have the panelists introduce themselves. So, starting with you.
Jason Drattell, the founder of Praesidian Capital.
Graham Smith, the CEO of Open Energy Group.
John Goodall, co-founder and CEO of Landbay.
Yeah, I'm Andrew Bertolina, the CEO of Finvoice. We're a marketplace for receivables, primarily in a little bit more niche asset classes.
That was an awesome and very fast, very efficient introduction. Pat ourselves on the back. Look, the difference between secure and unsecured lending, the main difference is the availability of collateral for collection. So I guess a question that often comes up is there data suggesting that secure asset class actually performs better during a recession? Jason, you've had extensive experience investing in both secure and unsecured assets. What are your perspectives here?
Well, maybe to preface my comments, point out that we are direct lenders to balance sheet lenders to operating entities both in the U.S. and the U.K. And from a definition to us of secured versus unsecured, we in our language, we view secured as more asset-intensive, heavy asset-type transactions than unsecured, more asset-like. Because at the end of the day, we do need security interest or lien in case we need to exercise our remedies. I started off 30 years ago, ingrained in me that secured loans are better risk-adjusted returns. But I stand here today to say that I have a total different view of that. And it was driven by the fact that if I look back when I raised Praesidian about 15 years ago and investors would ask me, do you prefer to do secured or unsecured loans? Where are those risk-adjusted returns? I look back and all the market corrections, whether it's the early 90s, late 90s, 2000, I didn't see any distinct difference in performance of secured versus unsecured loans. And my answer was, we're indifferent. The focus is quality management. That all changed in 2008 when we had a significant market correction and the unsecured or asset-light loans performed significantly better than the secured loans. And in hindsight, having witnessed that, I attribute that to two factors. One, the companies at that time, given the state of the market, needed time to correct, and the asset-heavy companies do not have the financial flexibility to do that. And another issue that came to bear is the banks that were ahead of us in some of those transactions were under the false illusion that they actually had quality collateral, yet the market was inundated with that collateral, and they acted quite aggressively and ended up with significantly reduced returns.
You just threw all your co-panelists under a bus, a big speeding bus. John, Graham, maybe one of you guys start.
Yeah, I'm happy to comment on that. And to put it in perspective, so Landbay is a UK buy-to-let mortgage lender. So the buy-to-let market is, I think in the US, what you call rentals. In the UK, it's around about sort of 20% of the mortgage market. And this is purely for sort of residential assets. And what I'd say, obviously, the thing about sort of secured lending, and particularly lending on property, and I think we're often sort of lumped together as one asset class, but there's a huge variety of returns. And if you look at, say, from a UK perspective, the cheapest kind of mortgage in the market right now, you're probably getting 1.5%. So that's the sort of borrower rate for sort of super prime UK residential mortgages. And then at the other end of the spectrum, you've obviously got sort of heavier development, building, particularly on sort of, and some commercial lending, which is kind of 25%. So trying to compare all that as one asset class is a very, very difficult thing to do. And that range of returns is probably mirrored slightly within something like consumer and SME lending too. So I think sometimes the secured versus unsecured is sometimes a little bit of an artificial split. In our sector, in buy-to-let, there's a lot of buy-to-let mortgages that were securitized, from 2003 onwards. some very, very big lenders securitize them, and all that data was very, publicly available. And, buy-to-let, in the worst years, which were around about 2009, 2010, the losses were around about 50 basis points sort of on buy-to-let. The returns obviously are much lower than others. I mean, in the UK right now, people are lending at 4 to 5%, but those returns are relatively stable even in a sort of downturn. So you don't get the sort of height of the high returns in the upside, but the returns over the cycle are pretty stable because those losses are very, very low typically.
Prefacing the fact that we're probably each going to talk up our own books, I'll go for it. So I think it's secured versus unsecured, but also what's appropriate lending for a sector. So we lend, we're an origination platform for US commercial solar. We take project finance, and project finance is, for those who are familiar with it, is by nature secured. So if we talk about the downturn and what was appropriate, then I guess if we, the credit we're looking at, and I guess if you're looking at a downturn, typically the data is from at a utility scale. We look at that currently as what was significant then, since that's what the majority of loans were made then back in the crisis, and that's with AA, AAA rated entities, and I guess they're probably one of the least likely groups to go bust. So our loans are analogues of that. So we're looking at investment grade cash flows that are secured.
Graham, maybe following up on that point, for secured assets, the underwriting, the process of underwriting is quite a bit different, right? And it's not the same across different asset classes. How does the underwriting process matter, and how does it differ from a traditional unsecured underwriting? And this is for an investor looking at these asset classes. This is additional things to learn. Like, why should they care?
I remember when you asked this question, I struggled with it. The reason I struggled with it, you can't separate it from project finance. The idea of unsecured project finance, it's basically SME lending. And for those that aren't, I guess for those that aren't familiar with project finance, I was trying to think of an analogy, so bear with me on this, but if you thought about consumer lending, you got the borrower, there's the consumer, and obviously the lender, and we add a third group. So if you can imagine the consumer's employer, and the consumer is getting employed by the employer on a 15-year basis, on a 15-year contract. So imagine that. And that employer is like a bank, and the employees, for our underwriting purposes, is very good. So they're unlikely to break the contract, and they're going to get paid for 15 years. And then so every time the employer pays the consumer, so if you think of that cash flows, and this is part of why we're confident in our area, instead of us taking the money from the consumer, which is kind of how consumer lending goes, you pay the loan, the pay slip, if you like, from the employer to the consumer comes to an account we control, we service our debt, and then we give the rest of the money back to the consumer. Additionally, we have, I'll stop the analogy there because you're probably confused, but it's that idea that the security is over the cash flows and we control that before the consumer gets their money. So we service our debt first, and then ultimately we've got the underlying assets. So it's this idea of assessing, if you imagine, you can see and we have control over the money coming into the consumer's account, and that's pretty powerful. So it's all about assessing who's paying the consumer, if that makes sense. So it's an absolutely core part of our underwriting. So
the underwriting is important, and its structure is certainly very particular. John, maybe you can take a slightly different angle here on the real estate side. What are some of the factors that are particularly important for secure lending that may be different from unsecured?
Yeah, I mean, so I think on any type of loan, I think there's two things that broadly speaking, from a credit department, you're going to think about. What is the risk of default, and then what is the loss given default, and obviously where secured is very every type of lending will look at what is the chance of default. I think the bit that is obviously very different for secured lending, particularly property lending, is okay. Well, if there is a default, then actually what is the percentage that you might lose that loan? And when it comes to property, therefore, the collateral is obviously a first lien in our case on a residential property. And so really, that depends on obviously the loan to value at the beginning of the loan, but obviously the value of collateral is quite volatile. And, obviously in the house price crashes, they can drop by 20, 30%. So, I sometimes amuse when people say, oh, we only ever lend to certain LTV, because actually that loan to value can change drastically throughout the term of the loan. And I think people sometimes forget that. They think, well, 75% loan to value, that there's a good buffer there. That buffer may not always be there. And so I think that's the bit you really, for secured lending, you have to think about. What is that collateral? What is the liquidity of that collateral? And what is the potential downside? So, some assets in terms of property, you can sell them, repossess relatively quickly. Some other, the type of property, they'll take a lot longer to sell. And then also from our point of view, which is, I think, specific to buy-to-let, is because their cash flows attached to these properties, these are rentals, and we can take charge of the rental and become receiver of rent. It's like also what is the volatility and chance of lending, if we don't want to sell, what is the chance of us being able to rent this property out so that we can sort of see through the cycle. So I think that, that loss given default thing is the bit that is very different. I mean, there is obviously a different credit process in terms of risk for default for property, but that's an underlying sort of credit assessment for anyone, I guess.
So these are all, I guess, even among secured assets, these are all very different asset classes. I guess a big question may be, what are some of the expected returns we're talking about? And maybe starting with you, Andrew, given on the invoice side, it's on the other end of the spectrum, very short duration.
Yeah, so it's really interesting hearing the project finance and the real estate guy, because our average tenor is around like 30 days. So the average, we do invoice financing. The average invoice in the U.S. is paid in 60 days. So very short dated paper. The factoring industry has been around since the 17th century. George Washington had a factoring company. The average rates of return are typically between 30 to 50% annualized. We try to do half that. And the big idea, or not so big, behind Finvoice is we think invoice financing is the best way to give a small business credit. So it should be the cheapest form besides a SBA loan. But if you look at it from an asset class perspective, that's still pretty attractive for a secured loan, for secured invoice from like Amazon, so 15 to 20%.
On our mortgages, we're sort of lending out typically between 4 and 5.5%, which obviously is much lower than a lot of other forms of lending. Now, I think it's worth saying in the UK rates are lower, as I said earlier. On home loans, rates in the UK are typically sub 2% now in the current environment. So they're generally, buy-to-let is generally sort of 150 basis points or so over and above home loans.
Yeah, the returns we offer in the 5 to 6% range.
For us, I first speak to the U.S. Our pricing has not changed literally in 30 years. And in the last 15, for example, we've done 70 transactions, and the cash yield is 11-12%, about 200 basis points of PIK interest and a equity kicker, and with a closing fee, and that's been consistent literally for decades in the market here. We started our fund in the UK 2 years ago, and so we're targeting gross returns at kind of mid to high teens. And we started our fund in the UK a little over 2 years ago. The pricing there has been, on the cash base, about 200 basis points less, but the closing fees are much higher, and the equity kickers are quite similar. So we're looking at pricing in the UK. We're about to close our 9th transaction, hopefully next week, and it's been 8 to 10% cash, about 200 basis points of deferred interest, closing fee, and an equity kicker. So we're quite confident that's going to hold in the market.
So, Jason, following up on that, from the investor's perspective, what are some of the, you're hearing about all these different asset classes, and these are all very different asset classes, each requiring a lot of due diligence. What are some of the factors, and what are some of the approaches that you think an investor ought to take in looking at each of these asset classes?
I think it's just more a function of diversification of that particular portfolio and what yield they're looking for, and certainly the risk-adjusted return. And really based on the track record of the particular asset class, the managers they're looking at. But for us, what we've been able to offer, the bulk of our return is in the yield, and if we do a proper job of underwriting and monitoring the transactions, that we feel risk adjusted. It's been a very consistent return. We certainly compete with various other types of secured, unsecured lending, and I think they're all viable in different ways. It's just a matter of what type of portfolio a particular investor wants to build. The last few years there's been a huge appetite for yield, and the fact that we've had a consistent yield in our product for quite a long time, I think helped us also do quite well fundraising in the UK market.
So Graham, for anyone looking at project financing and solar, what are some key criteria that you think the investor ought to look at?
Beware. No, but project finance, is a particular beast. It is the preserve of typically, pension companies, insurance companies. They're looking for their buy and hold investors predominantly, and what we do know about renewable energy loans is that a lot of them reside currently in insurance portfolios. Whether it's wind or solar at the utility scale, they bought into that, and we know from those groups that they are looking at, in our case, the commercial sector, but the challenge, as is often the case, is they need enough scale, so they don't get out of bed for less than $50 million. There are other nuances in there, so the investor, looking at it, can wait for securitization and a rating, and then it sits alongside, and that's ultimately our goal, that it sits alongside, it's in the $1 trillion investment grade bond market, and that's where we hope our product will lie, and is differentiated in as much as it's undifferentiated, it's unsexy, it performs, it maintains its investment grade rating.
John, in buy-to-let, what do your investors look at?
So I think, again, there are some comparisons, I think, with Graham's there, in the sense that the sort of institutional investors that go into this part of the mortgage market, it's done at scale, generally speaking. And, historically, obviously, this, not historically, but today, it is dominated by banks and then also some wholesale lenders. There are some asset management, business and insurance companies that are coming into it. But also, again, probably like Graham's, the tenure is longer as well. So, typical mortgages are 25 years. Ours are not that long. Ours are sort of 5 to 10 years. So it is a slightly different sort of type of investor that you'll get in a lot of other platforms.
Okay.
Yeah, I just like to reach out. Yeah, we're 10 to 15 years, so not for those who aren't in it for the long haul until it's securitized.
And then for the short duration side, Andrew, what should investors in invoices look at in platform and in collateral quality?
Yeah, so the primary ways that factors underwrite is they first look at who's the counterparty, then the strength of relationship, and finally they underwrite the borrower, who they take out a lot of protection. So even if borrowers in distress, which they often are, they have recourse or other protections. So that's the underwriting fundamentals of factoring. Yeah.
Okay. Well, final question. Quick answer from each of you to wrap up. I mean, what do you in your particular area? What do you think are the biggest opportunities in 2017? Starting with you, Jason.
I mean, for us, given our niche, it's in the SME sector. Even this market here in the States is still incredibly underserved. And, for us, it's just maintaining discipline and being quite selective, because there continues to be a tremendous need as the banks gravitate further and further away from these small transactions. We are even more optimistic about the UK market. It's in its infancy, but there's a tremendous demand for our product there as well. From a sector standpoint, we're very much generalists and focusing on quality management teams. So for us, again, it's just we've been inundated with deals. It's frankly just a matter of maintaining our discipline and being methodical.
Graham?
Three things I'd like to echo. The first point that yield and attractive risk-adjusted return is, unless the Fed goes nuts. But so that's number one. So that will continue to drive investors in. I think, secondly, ironically, it's actually we're drawing banks in. We're teaching, and we see as our value as a dialogue between the capital markets and the underlying product, and banks are interested in this product, and we're working closely with them. And lastly, the continued dynamic of in our market that's intriguing. That when we buy electricity, most of us don't think about it, but solar is in a majority of cases in the States and the US is cheaper. So as a business, you can buy cheaper solar power than your conventional power, and that delta is only going to go more in favor of solar. So it's going to be a long runway.
Yeah, so in our market, we think there's a huge opportunity over the next few years for a number of reasons. So the buy-to-let market in the UK, there have been there either have been or there are three things sort of happening that mean that banks will increasingly become less competitive in this space, and banks are sort of still 85% of the market today. Firstly, the tax regime is changing in the UK, which means that it's far more tax efficient for people to hold these buy-to-let properties within companies, SPV structures, rather than holding them direct themselves. That's an area that typically the banks won't do. Secondly, buy-to-let is coming under PRA, and PRA is the Prudent Regulation Authority, which is part of the Bank of England, and buy-to-let, where banks are concerned, is coming under their auspices as well. And then finally, Basel, the latest consultation from Basel, is now, from a bank's point of view, treating buy-to-let loans like commercial real estate, and so the capital requirements that bank will have to hold will, depending on LTV, double or triple. So while we see fundamental growth in the rental market in the UK, we don't feel that the banks can actually expand their lending within this space unless they do it with platforms like ourselves, and actually we think they're likely to shrink their books well. So we think there's a lot of structural change, and some of that will go to wholesale lenders, admittedly, but I think some also to marketplace lenders. Yeah,
so the vision for Finvoice the next year and forward is creating an asset class. Like most of the people are here, different types of asset classes. Our asset class will price between commercial paper and the short tenor bond market, because the idea is an Amazon invoice to Tom or to Joe or to Graham should be essentially have the same credit risk if you can take out the nature of the contract. So creating a uniform asset class. And we're fundamentally technologists, so we think using real types of data, not social media data, can kind of lead that. So that's the way we're going.
Well, with that, I think we're out of time. That concludes the panel. Thank you for being a great panel today.